Coming up, property prices fall for the first time in 2 years. The Australian dollar at its lowest against the US in about 2 years. And we take a look at how investors are feeling as we start 2025. That's all next. Hi everyone, it is your daily 10-minute business and finance news wrap for this Thursday, the 2nd of January 2025. The Australian share market rose on the first trading day of the new year, up by 0.5%. We'll have the details with Gemma Dale from NAB Trade. But first, for the first time in nearly 2 years, national property prices have fallen. CoreLogic says the median now sits at less than $815,000. That's down 0.1% in December. But over the year, values are still 4.9% higher, and that's despite high interest rates and the rising cost of living. For more, I spoke with Tim Lawless, the head of research at CoreLogic.
It was definitely a year of two halves, Ricardo. We saw the market start the year very strong, but pretty much through the second half of 2024, it was best described as a fade. Most markets were losing momentum through the second half of the year. Sydney drifted into decline over the past 3 months, or the last 3 months of the year. And even the mid-sized capitals, which remain quite strong, were clearly moving through their peak rate of growth as well around the middle of the year. Still ending the year, I mean, in Perth, values up nearly 20%, so quite extraordinary. But we're definitely seeing the signs of affordability constraints, less investments, and just the impact of ongoing high interest rates really starting to put the brakes on markets around the country.
Still, given that we saw a period of high interest rates, cost of living pressures, does it surprise you to see that the market was still positive for the year, though?
Absolutely. This was a really surprising growth cycle. Typically when we see things like high interest rates and cost of living pressures, a reduction in household savings, low sentiment, all of these things would typically add up to negative movements in housing values. I think the key reason why we've seen this ongoing strength in the market up until recently just simply comes back to low levels of supply. And you can really see that in listing numbers. Up until the middle of the year, listings were generally extraordinarily low in most markets. But as we came into the spring selling season, listings started to accrue pretty much everywhere, demonstrating both a real uplift in vendor activity that simply wasn't matched by a rise in buyer activity.
Okay, you just said until recently, right? So we saw that peak in October. We're now seeing the first decline in quite some time in December. Run us through what's happened here. What's the shift, and is further weakness expected into 2025?
Yeah, it wasn't like we saw a real inflection point in the marketplace through the final quarter of the year. This was a very much a gradual slowdown through the second half of the year. But it did coincide with the spring selling season, seeing a lot more stock coming in the market. Finally, buyers had more choice. There was less urgency. They could negotiate harder. Affordability constraints were really becoming quite obvious, particularly in the usual suspects like Sydney, but also markets like Adelaide. Serviceability in Adelaide, when you adjust for local incomes, was the second worst of any capital city after Sydney, so at record levels. But we also started to see things like, sentiment started to pick up towards the end of the year as cost of living pressures started to come down, and we started to think interest rates would be reducing in 2025. That hasn't been enough to support housing demand. And maybe this is a factor of just less population growth coming into the country as well. So I think this is really setting the scene for a pretty weak start to 2025. We're expecting further falls in our national index through the first months of the year, at least until interest rates start coming down. And even then, I don't think that's going to be the catalyst for a renewed growth phase. I think we'll need to see rates coming down a lot further before we start to see any material improvements in housing markets.
What about the split between capitals and regionals?
Well, the regional markets outperformed the capitals through the year. A 6% rise in the combined rest of state markets across the year, compared with a 4.5% increase in capital city values. But again, there was a lot of diversity here. Those headline numbers were really being driven by WA, by South Australia and Queensland. And in those markets, it was typically the more rural markets that were really showing the strongest growth. In Queensland, for example, markets like Townsville, Mackay, Gladstone, Rockhampton, all seeing 20% plus growth through the year. In WA, it was Bunbury and Geraldton really driving the stronger trends. Whereas at the other end of the spectrum, markets in Victoria were down over the year, particularly led by areas like Ballarat. Values there are down about 15% from the 2022 peaks. Geelong quite weak, same with Gippsland, Latrobe. So Victoria really standing out both from a capital city and a regional perspective for quite weak conditions.
Just a couple more questions. We know we're heading into an election year. It's all about cost of living. One of those big costs, rents, right? What happened with rents during the year and what's likely to happen into 2025?
Finally, we're seeing some rental relief for renters. The past 6 months, so the last 6 months of 2024, saw our national rental index pretty much flat. In fact, some markets like Sydney and Melbourne were down a little bit in their rental rates. So I think we're starting to see the impact of both rental affordability pressures, forcing a restructure in rental demand as group households reform and households become larger, but also this ongoing slowdown in net overseas migration is flowing through to less rental demand as well. And I think this is something we should expect further of or more of in 2025. Overseas migration is probably going to settle around the middle of the year, hold around normal levels. And we'll probably continue to see average household sizes getting back to pre-pandemic levels as well. Both factors helping to diminish rental demand and see some stabilization, if not some downwards pressure on rents around the country.
Okay, given everything you've just said then, is there still value for investors out there if they're looking to get into the market or buy? Where do you see the growth hotspots for the year?
Yeah, it depends on where you're looking. I think value you can measure on, say, a yield for investors. And generally, we're seeing rental yields very low around the country. There are a few exceptions. Melbourne's a really, really good example of a market where rental yields are consistently rising and where housing values have come down, providing a much more affordable entry point to the market. I wouldn't be surprised if we do see investors looking a little bit more proactively at Melbourne for medium to long-term capital growth potential. But I think those medium-sized capitals like Perth, Adelaide, Brisbane will remain on the radar for investors. They're still showing a pretty decent rate of capital gain, even though it's slowed down, and especially Perth seeing a very high rental yield, well above the national average.
It is Tim Lawless there from CoreLogic.
Now, Market Day on the SBS On The Money podcast.
Good start to the new year. The S&P ASX 200 up 0.5% to 8,201. For more, I spoke with Gemma Dale from NAB Trade. Gemma, the market up for the first day of the new year. Why?
Yeah, interesting question, right? Like the market was expected to be somewhat negative this morning. When we look at what happened in the US in the last couple of days of the trading year, or a little bit negative. So there was a bit of an assumption that we wouldn't start on the front foot, but we did. It looked quite positive. Materials really strong, sort of up 80 basis points, I guess. And there's, I think, a little bit of optimism if the iron ore prices held, that might give a little boost to Fortescue. It's holding rather than rising, but we'll take holding, I think, after the year that's been. And also oil prices were up. That helps the energy sector. So it was really all sectors in the green, but more low volume, breath of relief stuff, I think, rather than dramatic rallies.
What is interesting at the moment is movements on the Australian dollar, right? It's currently at a 2-year low against the US. What's that all about?
Yeah, this is a really difficult one, isn't it? There's a lot of concern that the outlook for the Aussie dollar is even weaker than it is now, and it's not looking terribly pretty. It's off 9% over 12 months, and it's driven by a multitude of factors. I think a lot of people have been very concerned with Trump coming in. The sort of US dollar dominance is not going to end anytime soon. That was very much the hope for a while there. We were predicting the dollar would get a little stronger. The Aussie dollar would get a little stronger because the US dollar would weaken eventually. But I think there's really been a shift in view on that. The Fed has also made it clear that their cutting cycle may not be as aggressive as markets were hoping. And then really it's fears about China, this concern that regardless of these somewhat anemic stimulus measures, we're just not going to see a dramatic turnaround in the Chinese economy. We've got so much exposure there, and it just continues to put downward pressure on the dollar.
Okay, so that's what's happening with currencies. Let's take a look at your crystal ball for 2025, right? How are investors feeling as they head into this new year?
Yeah, this is such a great question, and it's quite fascinating looking at different groups of investors because they're quite clearly feeling very different. In the US, the data points are fascinating. Surveys of investors, and this is retail investors, people like you and me, mums and dads, are the most bullish they have been. So they're very optimistic about US markets, despite the fact that there have been 2 exceptionally strong years for US equities. And the last period that matched that period of performance was 98, 99. Not the greatest comparison given what happened immediately after that. So US investors are feeling fabulous and they're very, very bullish about what's ahead. If I look at what NAB trade investors are doing, so what our investors are thinking and feeling, you can usually tell by whether they're selling more than they're buying and what the cash book looks like. At the moment, the cash book is very, very high. Now, one reason for that obviously is you can get a decent return on your cash for the first time in quite a while. So people are just happy to sit on that rather than investing it in equities, but also they're just a little bit nervy about where the market finds itself. Certainly when you look at things like bank share prices, which have run just exceptionally strongly over the last 12 months, our investors have been trimming really hard and they've just been taking a little bit of risk off the table. They feel like those shares have performed really well. They've done a little rotation into materials and energy, but the rest of it, they're just happy to sit in cash and wait for a pullback. They're not thinking it's going super hard from here.
That is Gemma Dale there from NAB Trade. Don't forget, if you enjoy this podcast, to give it a rating on Spotify or Apple Podcasts and to subscribe wherever you stream this podcast from. This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making